Generally Accepted Accounting Principles, GAAP. Introduction to GAAP. Generally Accepted Accounting Principles, GAAP, are a set of rules and standards used in financial reporting. GAAP provides a framework for accounting practices, ensuring consistency, transparency, and comparability of financial statements. The importance of GAAP consistency ensures that financial statements are prepared using the same method. Transparency provides clear and understandable financial information. Comparability allows stakeholders to compare financial information across different companies and time periods. Reliability increases the credibility of financial statements. Key principles of GAAP. Principle of regularity. Adherence to established rules and regulations. Principle of consistency. Use of the same accounting methods over time for consistency in reporting. Principle of sincerity. Providing an accurate and honest representation of a company's financial situation. Principle of permanence of methods. Use of consistent procedures and methods in financial reporting. Principle of non-compensation. Full disclosure of all financial information without compensating debts with assets. Principle of prudence. Reporting expenses and liabilities as soon as possible, but recognizing revenues only when they are insured. Principle of continuity. Assuming the business will continue to operate indefinitely. Principle of periodicity. Reporting financial information in distinct periods of time, such as quarterly or annually. Principle of full disclosure. Materiality. Providing all information that could affect the understanding of a company's financial statements. Principle of utmost good faith. All parties involved in financial reporting are presumed to act honestly and in good faith. Major GAAP concepts. Economic entity assumption. Business transactions are separate from the personal transactions of the owners. Monetary unit assumption. All financial transactions are recorded in a stable currency. Time period assumption. Financial reporting is divided into standard time periods such as months, quarters, or years. Cost principal assets are recorded at their original cost, not their current market value. Matching principal expenses are matched with the revenues they help to generate within the same accounting period. Revenue recognition. Principal revenue is recognized when it is earned and realizable, regardless of when the cash is received. Conservatism. Principal reporting expenses and liabilities as soon as possible, but recognizing revenues only when they are insured. GAAP versus IFRS key differences. GAAP is rules-based, while IFRS is principles-based. Differences in how revenue recognition, inventory, and other financial items are treated. GAAP hierarchy. Level 1. Statements and standards set by the Financial Accounting Standards Board, FASB. Level 2. Technical bulletins and guidelines from FASB. Level 3. Interpretations and guidance from FASB and other accounting bodies. Impact of GAAP on financial statements ensures that financial statements are consistent and comparable. Helps in making informed decisions by providing reliable financial information. Enhances the credibility and trustworthiness of financial reporting. Common GAAP violations: revenue recognition. Issues: recognizing revenue before it is earned. Expense recognition issues: delaying the recognition of expenses to inflate profits. Asset valuation issues: overstating asset values or not recording impairments. Key accounting principles. Key accounting principles form the foundation for financial reporting and are essential for maintaining consistency, transparency, and accuracy in accounting practices. 1. Accrual principle. Revenue and expenses are recorded when they are earned or incurred, not when cash is exchanged. This helps in providing a more accurate picture of financial health. 2. Consistency principle. Once an accounting method is chosen, it should be used consistently in all periods to ensure comparability of financial statements. Any changes in methods should be clearly explained. 3. Conservatism principle. When faced with uncertainty, accountants should report expenses and liabilities as soon as possible, but only recognize revenues when they are certain. This ensures that financial statements do not overstate assets or income. 4. Going concern principle. This assumes that the business will continue its operations for the foreseeable future and not be liquidated. Financial statements are prepared under the assumption that the entity will not cease its operations. 5. Matching principal expenses should be recorded in the same period as the revenues they help to generate. This allows for accurate measurement of profitability for a specific period. 6. Materiality principle. Information should be disclosed in financial reports if its omission could influence decisions made by users. This allows businesses to focus on information that is relevant to their financial performance. 7. Full disclosure principle. All information that could affect the understanding of a company's financial statements must be disclosed. This could include footnotes or supplemental data to explain specific items. 8. Cost principle. Assets should be recorded at their original cost rather than their current market value to avoid subjective valuations. This principle focuses on objective and verifiable data. 9. Revenue recognition. Revenue should be recognized when it is earned and realizable, regardless of when cash is received. This ensures that financial reports accurately reflect a company's performance during a period. 10. Economic entity principle. The business is considered separate from its owners or other businesses. All financial transactions related to the business should be recorded separately from the personal finances of its owners. Accrual versus cash basis accounting. Accrual and cash basis accounting are two primary methods used to recognize revenue and expenses in financial statements. While they both aim to provide an accurate picture of a company's financial health, they differ significantly in their time. Accrual basis accounting. Accrual basis accounting is a method of accounting that recognizes revenue and expenses when they are earned or incurred, regardless of when cash is received or paid out. This means that a company records revenue when it provides a good or service, even if the customer hasn't paid yet. Similarly, it records expenses when they are incurred, even if the company hasn't paid for them yet. Key characteristics. Revenue recognition. Revenue is recognized when it is earned, not when cash is received. This means that a company can report revenue even if it hasn't been paid yet. For example, if a company sells a product on credit, it will recognize the revenue when the product is delivered, not when the customer pays. Expense recognition. Expenses are recognized when they are incurred, not when cash is paid out. This means that a company can report expenses even if it hasn't paid for them yet. For example, if a company receives an invoice for utilities, it will recognize the expense when the utilities are used, not when the bill is paid. Matching principle. The matching principle states that expenses should be recognized in the same period as the revenue they help to generate. For example, if a company spends money on advertising to generate sales, the advertising expense should be recognized in the same period as the sales revenue. Advantages. More accurate financial picture. Accrual basis accounting provides a more accurate picture of a company's financial performance than cash basis accounting, which only recognizes revenue and expenses when cash is received or paid out. Better decision making. Accrual basis accounting can help companies make better decisions about their business operations. For example, a company can use accrual basis accounting to determine its profitability and identify areas where it can improve its operation. Required by most accounting standards. Accrual basis accounting is required by most accounting standards, such as Generally Accepted Accounting Principles, GAAP, and International Financial Reporting Standards, IFRS. Disadvantages. More complex. Accrual basis accounting is more complex than cash basis accounting, as it requires companies to make estimates and judgments about future events. Requires more time and effort. Accrual basis accounting requires more time and effort to implement and maintain than cash basis accounting. Cash basis accounting. Cash basis accounting is a method of accounting that recognizes revenue and expenses when cash is actually received or paid out. It's a simpler approach compared to accrual basis accounting, which recognizes revenue and expenses when they are earned or incurred, regardless of cash flow. Key characteristics. Revenue recognition. Revenue is only recognized when cash is received, regardless of when the goods or services are delivered. Expense recognition. Expenses are only recognized when cash is paid out, regardless of when the expenses were incurred. Advantages. Simplicity. Easier to understand and implement, especially for small businesses with simple transactions. Clear cash flow. Provides a clear picture of a business's cash inflows and outflows. Tax benefits. In some cases, cash basis accounting can offer tax advantages. Disadvantages. Less accurate financial picture. Can distort financial performance, especially for businesses with significant credit sales or long-term projects. Limited decision-making tools. may not provide the necessary information for strategic decision-making. Timing records transactions when earned, incurred. Records transactions when cash is received, paid. Complexity. More complex to maintain. Simpler to maintain. Accuracy provides a better picture of financial health. Focuses more on actual cash flow. Compliance required for larger businesses. GAAP/IFRS, typically used by small businesses. Financial reporting, better for understanding profitability, may not reflect long-term financial health. Which to choose? Accrual accounting. Accrual accounting is better for businesses that need to provide detailed and accurate financial statements to investors, banks, or regulatory bodies. Cash basis accounting. Cash basis accounting is often sufficient for small businesses or sole proprietorships that prioritize tracking immediate cash flow over detailed financial reporting.